comes down to computers communicating.
The information superhighway can be a confusing mix of on-ramps and off-ramps.
Bitcoin is worthless artificial gold.
Is it still rat poison?
Probably rat poison squared.
We need to get into the world of, okay, this is actually foundational technology.
What the Internet of Money does is it creates a single network which can do a microtransaction to a gigatransaction.
The Internet is going to be one of the major forces for reducing the role of government. The one thing that's missing, but that will soon be developed, is a reliable e-cash.
Alrighty, gentlemen. Welcome back to another episode of Final Settlement. Today is Monday, January 12th, 2026, 11:15 a.m. Eastern Standard Time. Gentlemen, how are we doing? We got Michael, we got Liam, we have a special guest, Nick, which we'll get to a formal introduction for him a little later in the show. But we've got a big show, ton of links on the list. A lot has happened in the past week, the past few weeks. The world is changing quickly, and yeah, we're going to jump right into it. So the first headline we wanted to get to, this actually dropped, I think, shortly after we recorded last week. So we didn't get a chance to touch on it. But Morgan Stanley filed for their own Bitcoin ETF. Also a Solana ETF, but we'll ignore that for now. They registered for a Bitcoin ETF. And this is a big deal for a number of reasons. I'll sort of kick things off here and then get thoughts from the group. But this really stuck out to me as, you know, we've kind of become numb to a lot of the headlines around whether it's M&A activity, partnerships, ETF filings. But this one is different in the sense that Morgan Stanley is not historically a big ETF factory or shop necessarily. They have a handful of funds that they manage, ETF funds that they manage. And only two prior to this actually had the Morgan Stanley brand name on it. They have sort of sub-brands like Calvert and Parametric that they manage ETFs for. But in terms of the very short list of Morgan Stanley branded ETFs, the Bitcoin one will be the third ever, which is a pretty big deal. I think what it also tells us is that they've seen the success of IBIT and BlackRock and realized that, you know, they can allow their clients to access IBIT, but they're only earning a very de minimis sort of revenue on that. And if they really wanted to capture the economics of these massive inflows that we've seen to spot Bitcoin ETFs, then they should probably get into the issuer game. And that's exactly what they're doing. So there's more to this too around sort of a broader Morgan Stanley push, but I'll kick it to you guys. What do we make of this? How big of a deal is it?
Yeah, I mean, I think this is huge. We touched on it, and maybe I'll let Nick or Liam if they want to touch on the ETF flows and just how big of a deal that is that Morgan Stanley launched or is going to be launching their own. We did go pretty deep last week on the last trade here. Where I want to kind of focus, at least from my side, is a report that came out from Barron's. I'll pull up my screen really quick because I'm not sure if you have it. You might. But it's really the Morgan Stanley head of wealth management, Jed Finn, coming out. And I'll read a couple quotes from there. One is, it all fits together in a broader strategy of adapting to the change in the industry, and in some cases, driving the change in the industry. And it effectively brings out Wall Street announcing, one of the big things that they announced, they were investors in Zero Hash, and then E-Trade is one of the platforms that sits under the Morgan Stanley umbrella that I believe is either on or it's going to be turning on the ability to buy Bitcoin, Ether, and Solana. I guess it's on track to go live the first half of this year. But also Morgan Stanley is now rumored, and I don't think it's rumored, I think it's confirmed via this Barron's article, that is planning to launch its own digital wallet. And it effectively says the company envisions its in-house offering as a platform to eventually handle transactions, not just involving coins, but also tokenized assets. With the excerpt, this is really a recognition that the way that the financial service infrastructure works is going to change over time as our infrastructure develops. We'll be able to do more with blending of traditional finance or TradFi and decentralized finance or DeFi ecosystems. This could mean borrowing against crypto holdings to buy equities or vice versa. For example, making loans against crypto in cold storage. And I think that is just kind of a very incredible excerpt in filing on what they're saying, what they're doing, because it goes so much deeper than passive inflows from private wealth into IBIT or an ETF shares, into the recognition that the plumbing is fundamentally changing from stable coins, real world assets, to the underlying Bitcoin. You can imagine some gold exposure will probably start to come about in 2026 as well. And then the realization that what people will want to do with those assets, from cross collateralization to bidirectional, right? So traditionally, we've talked about individuals leveraging their underlying BTC or IBIT holdings to get some dollars, but you can see the other side of it where you can leverage your equity holdings to get margin to go and buy BTC or other shares. And I think that but you take that and then you take a digital native way for a giant like Morgan Stanley that manages trillions of dollars in assets. And it effectively tells you that there's a race inside Wall Street to develop best in class solutions across the spectrum, not just for other institutional investors. And I think that this is really kind of incredibly bullish to see that the market's understanding this just won't be in an ETF wrapper. Because if it was, this wouldn't be out. They wouldn't be working on this. They wouldn't have invested in Zero Hash. They wouldn't be implementing it via E-Trade. So yeah, I just thought that was probably one of the most incredible insights outside of obviously the ETF filing.
Yeah, that's a great point. And do you guys know for sure if they will be custodying it themselves or if they're going to be outsourcing that to Coinbase via the S1 filing? Did they share that? I believe it says they're outsourcing it, but I don't know if they named in the S1 who the custodian will be.
Yeah, other qualified custodians. So I'd imagine it's in the same realm of the BitGo's, Coinbase's, potentially Fidelity's, depending on the kind of competitive standing there.
Yeah, for sure. That makes a ton of sense. And I would imagine, just given whatever conversations that they had and likely not like doing their due diligence on Coinbase, BitGo, et cetera, they realize that they can't fundamentally know exactly everything that's going on with their custody. Otherwise, there would be a point of failure with respect to how Coinbase or Fidelity or whoever else is actually custodying their asset. And obviously Morgan Stanley isn't going to be, as sophisticated in custodying digital assets themselves, but that's likely an impetus for the reason why they're investing themselves, and just the fact that they know that they need to have a solution for their customers. Their customers are going to want something differentiated. Otherwise, they're just going to go to the ETF, whichever has the most volume, so that they can get, just better pricing into the model themselves. This is really, it can't be understated how big this is. The fact that they're really offering everything, not just exposure, but know that clients are going to cross collateralize across equities and other asset classes. And Bitcoin's a big one that's here to stay across likely a large number of clients. Like this is something that I'm sure that they've been getting a lot of demand for, because they were one of the first firms to turn on the IBIT for their customers. They've had that going for almost 2 years. And they've realized, I'm sure, just from feedback from their customers, that they need to get into this game in a bigger way. So it's pretty big to see. Yeah, it seems like that was a natural sort of like fact-finding exercise for them to offer IBIT to their clients, and then see how material the flows actually were from their underlying clients. And just to put a little bit more context around, I think, what they saw in terms of the success. So BlackRock's IBIT ETF, fastest growing ETF of all time, quickly became BlackRock's most profitable product, more so than their S&P 500 ETF. And they've amassed a pretty large, substantial sort of head start or lead. I think at peak, assets in IBIT broached 100 billion. And so if you're sitting in Morgan Stanley's seat, like you did your fact finding, you realized there was real underlying demand for this thing. It wasn't going away. The TAM was very large, more than most people on Wall Street probably anticipated. And so despite sort of being a late entry to this, they are going to try to compete with BlackRock. And to your point, Liam, like the question then becomes, it's like, okay, well, why is it different? Why should someone buy Morgan Stanley's spot ETF as opposed to IBIT? If it's, at current much smaller, I'm sure they'll sort of ramp it up pretty quickly with some anchor investors or whatnot. But that is an open question. How do they differentiate themselves? Do they pick a different single custodian than Coinbase? Do they go with someone else so they have a little bit of differentiation? That becomes a real question because this is basically a commoditized market at this point. Like spot Bitcoin ETFs, the way they're constructed, most of them outsourcing it to Coinbase. It'll be interesting to see how they actually plan to compete with IBIT because, again, they are sort of behind at this point.
Two things to call out that I think are incredibly bullish is to Liam's point that they've had ETF exposure turn on for, call it 2 years. If I recall correctly, when they first turned it on, it was relatively low exposure. Maybe it was just for like private wealth investors over a certain net worth or assets under management. And you think about like a firm like Morgan Stanley and how slow TradFi moves, that you can bet that them turning that on, they already had plans for all of this, and it took 2 years to get it live, if not longer. And so that should set a precedent for a lot of the undercurrent, the things that we haven't seen that are being worked on. And then to the other point is they more than likely know what their clients want more than their clients do, right? Like these are people at the top of their game. This is how they make their money. And we've been talking about how we've been in this kind of like quasi bear market where the demand has historically been for this price uptrend outside of any like sovereign bid, that there had been for 17 years, people like Morgan Stanley that had clients that were looking for exposure, and the ETF allowed for simple exposure. So that's demand that had been sitting there on the sidelines, waiting. Point being is that they know that there's interest across these products. And so that's why they're looking to go and develop them. And it really ties into the interest and opportunity to build in this space and build differentiated solutions, because these firms are fully not going to be able to bring the talent in and come up with innovative ways. And so there's going to be a huge op as you go across, whether it's lending, custody, financial services that have that Bitcoin feel, whether it's today or the price is $140,000 and then they have to look different than their competitor. It's going to come because they're playing to win, and winning isn't going to be in an omnibus fashion, holding hundreds of billions of dollars long term.
Yeah, that's well said. Nick, any thoughts on this one, or I can jump to the next?
Yeah, no, I mean, I think in terms of added flows, I mean, it's going to build on what we've already seen, right? You already knew that they were going to turn this on. It's already starting to happen. I think they probably will look to bundle some stuff with like some of their existing high net worth client base. They're probably going to say like, hey, they may bundle some things to try to compete with IBIT, because again, I mean, they're basically the same product, right? Yeah, I'd say that's all I have on that one.
Yeah, I mean, the only other difference that I thought was somewhat interesting was like, I believe BlackRock has an Ethereum ETF as well. And so it's interesting that Morgan Stanley decided to do a Solana ETF as sort of like their extra outside of Bitcoin. And maybe that's how they think they're going to differentiate in terms of those sort of flows on the margin outside of Bitcoin, but remains to be seen.
The next day too, Morgan Stanley did file for Ethereum ETF that was
they did. Okay.
So maybe it just took an extra day because of whatever staking. I don't necessarily have any deep insight there too, but they also did file for that.
Good to know. We mentioned wallet push from Morgan Stanley as well. Another wallet related news from last week was Rumble and Tether launched their crypto wallet. Liam, I'm going to hand this off to you. I know you've taken a look at this a bit, and what do you think the implications of this are?
Yeah, it just shows how fundamentally broken money is, that anytime that you want to get payouts for, providing value to society, that like nobody actually wants to just use dollars in general, or the fact that you need to pair dollars with so many other assets right in the platform itself versus just going out and taking the dollars and going to best in class financial services. Everything is starting to almost be gamified, or almost there's going to be prediction markets into a number of different asset classes everywhere. But I mean, Rumble has almost 50 million monthly active users. So they're definitely not small. Incorporating stablecoins, Bitcoin, and Tether's tokenized gold product in there is pretty interesting too. And it's definitely more of a, I'll say libertarian type crowd on Rumble. So it'll be interesting to see what type of traction they actually get. YouTube is obviously significantly bigger, almost 3 billion users on there, and they're just launching stablecoins in itself. So will be interesting to see what type of Bitcoin traction flow they get on there before others have to compete. But a big portion of that makes it interesting for folks who are all across the world is just not having to set up a bank account, et cetera, to actually get capital directly to them and offboard it themselves. So interesting to see. I'm not sure how much traction they're going to get outside of a fairly narrow group of folks, though.
Yeah, I don't have much. I personally, I feel like the Tether barbell is interesting because the Tether on the side of sovereign exposure and what they're doing across dollarizing emerging markets and sweeping flows and really leading on that front, I find really interesting. I think on the other side, there's this mosaic. It's kind of chaotic. They're trying to paint in how do they get to the distribution and utilization from day to day. And I think they're looking for something, right? Because we look at Rumble and Tether and what does that look like? I know we've seen what YouTube's doing with stable coins. I think there's a lot of TBD. We talked about it last week or the week before that they're launching a wallet. I think that utilization on the end side, everyone's fighting for like the use case there, but I feel like they're very sophisticated in one angle, and the other side, it's like TBD to see how it plays out. And so you hear a lot of this stuff, and Tether obviously has a big name, but it's really kind of still theoretical on like how will creators in content interact with Tether. And then it's still just, it's going to be fascinating to watch what USDC and being closer to the US markets, right? I feel like USDC, Google, JPM, that's more of a like trad kind of experience. And you think about like just Tether and Rumble in itself are more of like on the outsides of kind of like specifically Rumble and in what most people would associate that platform for and is. So yeah, I think it's interesting to see the activity, but I don't necessarily know if it goes anywhere.
Well, it's an interesting point around the distribution angle because, a few months ago, Tether did a big push around USAT, like the US centric Genius Act compliant stablecoin that they launched. And they had some marketing, some sort of commercials around it, but it's very difficult, I think, in my mind, to get individuals to adopt and use something like USAT unless like you're doing like a UBI airdrop to them. And then, they're much more incentivized to use it. So in my mind, like this Rumble deal is basically a different parallel path to get like distribution, people using digital dollars, where you already have sort of an ingrained user base that is familiar with, a lot of the ethos of Rumble is like, anti-censorship, freedom of speech oriented type thinking. So it's kind of a natural fit to integrate these things into that existing user base. Because, there was some fanfare initially around USAT, but I haven't really heard much about it since then. Anything else on that one? Or we can jump to the Walmart OnePay deal.
No, I think just one thing I would say is like, it wouldn't surprise me if you see a lot of people that are like doing streaming, like especially like pro gamers or like things like that, people that stream on Twitch and stuff like that. It wouldn't surprise me if some of those people pick this up. Also, like in terms of people who stream on YouTube and stuff like that, I know there were a number of people, pretty well-known YouTube streamers and creators who were banned off of the platform for various reasons because maybe they didn't post things that YouTube necessarily agreed with. And so it wouldn't surprise me if you see some of those folks use this, because this would be a pretty like instantaneous way to get like YouTube donations and like receive, stuff through Twitch and stuff like that. It wouldn't surprise me.
Yeah, I agree with that. All right. Switching gears a little bit here. So Walmart backed super app OnePay hits a $4 billion valuation. I'm going to pull up a different article here, but Michael, I was going to hand this to you. Why is this a big deal?
Yeah, so I think the OnePay stuff is much bigger than people have talked about. I think it kind of ties into the transition from the Rumble conversation that maybe there's going to be a lot, if not future value on the margins, but today there really isn't. It reminds me a lot of like X and not even so much Substack, even though Substack has monetized. I think they just raised it or they just raised $60 million. Maybe the value, I think the valuation was much greater, but I think it was 60 million that they raised. Point being is that most people still stay to X, like the network effects where the conversation discourse is happening, very similar to like YouTube and what's happening there. And so when we transition over into like capital markets, I think of it very similarly, where US centric market, you're going to look there for value capture first in distribution before you start to get into like the fringes because again, when you think about Tether in emerging markets and the amount of capital flow that would come in through a wallet or financial service there is just fundamentally different than a US individual and their cohort and demographic and capital spend. So where the OnePay aspect gets interesting is because it came out, a few weeks ago that they were turning on buy, sell into digital assets and Bitcoin. I think it was only a few cryptocurrencies. The thing that's really fascinating, I didn't really recognize, is OnePay is top 12 finance apps. They're ahead of Robinhood, Amex, Schwab, Coinbase, around among a few others notable that you just wouldn't expect. And that it's like this one kind of like super app, in that it offers kind of debit cards via Green Dot, remittances, banking, buy, sell. And so I think this is interesting because not only does Walmart, in a certain segment of the market that they're focused on via OnePay, is traditionally kind of fits into that like Square, Cash App cohort that may not be able to get access to the best financial services, and that digital asset rails offer the ability to build better financial technology, better banking apps, and reduce a lot of the inherent friction that had traditionally occurred. And so I think OnePay via its distribution and what they're working on is kind of a signal where we will see other firms, whether it's like credit unions, challenger banks, start to incorporate some of this tech, because it's much easier to turn on pieces of like other additional products. And then also just net new players come in to be able to offer banking services to individuals that either couldn't be underwritten in a traditional financial sense, didn't make economics because of the customer acquisition costs a traditional bank has to incur when they want to win a client. And so I think that that's a big missing piece that we haven't really discussed in the market, isn't focused on, is when you disintermediate the ability to effectively be a bank, where will the value accrue from existing players that have better distribution and segments of the market that they haven't been able to acquire and win, and then net new players. So I think it's bullish in the sense of Bitcoin digital assets and net new players. I think it's somewhat bearish in either credit unions, old fintechs that are going to be a little slower in adopting some of this technology. Cousin of this or angle is like Revolut. Revolut, my understanding, their like stablecoin remittances and transactions have like blown through the roof the past, call it 12 to 24 months, where somebody like Western Union, or I forget what the other money, there's the other remittance firm. They've said they're coming into this game, but they haven't fully embraced or adopted it because their legacy businesses are kind of like predicated on the slowness of money and the fees they can transact. And they may be in the back, like the net new firm trying to do something different because it benefits them, like a Revolut may benefit tremendously.
Yeah, all great points. Maybe if we pull that through a little bit farther, you'd shared this tweet from Simon Taylor just talking about effectively the difference between having access to the distribution, like you're talking about, but then also, how that compares to like actual expertise and the ability to win. Like those are two different things effectively. So what is he talking about here in that context?
Yeah, I thought this was fascinating because it was like ties into that meme that's been passed around after the new year, that COVID or March 2020 crash was 7 years ago when it feels like 3 years ago. This idea that he throws out, or timeline, it feels like the JP Morgan Apple card was just launched, but it really was back in, I think they said 2019. It was really Goldman getting in, or Goldman, if I said JP Morgan, Goldman getting into the Apple consumer-based products and consumer lending products with the Apple card. So they partner with Apple. He references they cost about $350 to win the client. but they started to really hit significant losses year over year because of the way that they were underwriting the loans and the type of borrowers that they were approving. And so it went from, like, I want to say it says 2.93% in 22, jumps to 6.2% loss rates in 23. And then they started to slowly migrate and look for somebody to absorb that credit, and they had to absorb it at a discount, which it ended up sitting in as JP Morgan, because JP Morgan, I believe, they're the largest credit issuer for Amazon. They understand how to underwrite that. They have the distribution, but they also have the technical and the economic expertise to be able to do this. And so Goldman really came in, had the distribution, but they're not consumer-based credit lenders. And so they suffered significant losses. And I thought this was fascinating just from a traditional market, retrospective on, like, how, you want to develop a product, you want to get into a new space, but just because you want to do that and have distribution, if you don't have the experience and expertise, you may not be able to be successful. And it reminds me very similar as we start thinking about Bitcoin custody, Bitcoin backed lending, and other financial products, that unless you have the right taste, team, and distribution and experience and expertise, we're going to see a lot of these firms get in this game, but again, naturally not know where to play or how to play. And the easiest angle to go to is Bitcoin backed lending, because I think it's easily forgotten that while Bitcoin is the best, asset when it comes to superior, like, not only from custody, but from the pristine collateral that you get thrown out a bunch. It doesn't really matter how pristine the collateral is if you don't know these new primitives that exist. What are they? Well, it trades 24/7. It's more volatile than traditional markets. Times that are liquid, like where liquidity events usually happen in nights and weekends. This is empirically seen. I remember being back in the day running a lending book, and it would be like the one that always comes to mind is Thanksgiving evening. And because there would always be these crazy deleveraging moments around there, and TradFi's not prepared for that. And then that's not even accounting for rehypothecation and the reality. And TradFi always has that moral hazard that exists, that if we blow up, we will be bailed out because we matter too much. There are no bailouts in Bitcoin. And so if you get offsides in your lending book, there's nobody to step in. And we saw this happen in 2022. And so I think that's where this ties directly into, TradFi is going to come in. They're going to, participate in this economy. But the ones that are going to be prudent, conservative, are the ones that are going to survive to kind of be players in the space. And I think a lot may, end up in the same example as Goldman Sachs and the credit rating or credit lending on consumer side.
Yeah, I'd agree. I think that a lot of this ultimately is going to come from the consumer too, who's been in the space and going to ask, like, they're going to come out with their V1s and it's going to be okay, and it's going to be not have the assurances that many folks who have been who have taken out loans in the Bitcoin space before are really looking for, and they naturally won't necessarily all know the stories of BlockFi, Celsius, and what essentially went wrong there. And over time, the most sophisticated Bitcoin lenders who just have the most Bitcoin and have been in the space for the longest will just ask that they upgrade their products. Otherwise, they will only use it for a speculative amount and size their risk appropriately. And ultimately, that's just going to drive the market. And I do think a lot of those folks are more at, like, the Morgan Stanley side of the world than OnePay. And so it's great to have like Bitcoin and digital assets on there, but I think it's difficult to really make it a core part of your business or sell it without all the education that goes into Bitcoin. And just because there is so much confusion and conflation out there with digital assets in general. And so without that, I think it can be difficult to get the consumer on board. It's just having Bitcoin and digital assets out there is going to be a net positive, as long as they do everything like custody and making sure that the consumer is safe. But I could see it not getting quite as much traction within the broader app, although it's still great to see, just given the large amount of distribution.
Yeah, that's very well said. expertise is going to be critical. These players, these incumbents, whether it's the banks or other fintechs, have certainly realized at this point that they need to do something. And so now we're kind of watching the scramble mode period of a lot of M&A activity, partnerships. But again, going back to the broader point here, it's like you can have distribution, but having the expertise, the domain expertise really around Bitcoin and digital assets is another thing. And the issue there is that, attracting that type of talent who has that expertise is difficult for those players because, what hardened Bitcoiner wants to go work for Morgan Stanley? Few and far between, I would say. And so that's why you've seen a lot of partnerships and acquisition activity because they know they're now in a time crunch to be able to offer things to their underlying clients, and they don't have the expertise, they don't have the infrastructure in house. So maybe that's a nice transition to talk a little bit about early riders and the new year 2026, things we're focused on. The team is growing, so that's a nice segue to formally introduce a new member of the team, principal at Early Riders, Nick Johnson, who joined from TradFi, and I'll let him give a little bit more on his background. Maybe, Nick, if you could speak to your prior experience and then maybe how you got into Bitcoin, and then more so, what resonated with you about what we're doing at Early Riders and our thesis here.
Yeah, no, for sure. Thanks, Brian. Yeah, no, so super excited to be here and appreciate the opportunity to be joining the pod. So Nick Johnson, I was born and raised in Dallas. Family's lived here my whole life. I worked at Citi. So prior to joining Early Riders, I worked at Citi in San Francisco doing exclusively technology M&A. In terms of kind of my why Bitcoin, in 2020, my dad and I were watching an interview with Michael Saylor was on it. And I heard him talking about it, and he kind of just gave his whole thesis on why money is broken, why Bitcoin's the fix. And I just immediately got enamored by it. I was like, this is super interesting. And I knew there was just something different about it. I'd never heard anything, I had a finance degree, so I learned in school about inflation and how all that works. But, there was just, when I learned about Bitcoin, it was just different. And it seemed like the first asset that's ever really been invented that's truly the closest thing to perfect. And so that really kind of won it over for me. So I kind of went down the rabbit hole just like everyone else, and kind of realized, I was having a really good experience and learning a ton in investment banking. But I just realized that Bitcoin was just what I was super passionate about. And I always wanted to do the buy side in terms of private equity, venture, that kind of buy side world. But I really wanted to find a way to kind of intersect the buy side with Bitcoin because that's what I'm most passionate about. And so when Early Riders, or the opportunity kind of came about, I was like, this is perfect. I was like, this perfectly combines my interest in the buy side, my interest in investing, and also my, beliefs in Bitcoin and kind of my full thesis on that. So hopefully that's kind of helpful. But that was kind of the key drivers for me.
Yeah, no, thanks for walking through that. And I think, I believe, part of what drew you in was our initial white paper that we published close to 2 years ago now. But I'm going to pull it up here, and we're going to be re-releasing this this week, little refresh version, a little bit of a look back on what we got right, what we got wrong, where we can improve. But maybe, Liam, if you want to talk through a little bit about just the overall thesis and where we're headed in 2026.
Real quick, sorry, just before you go into the white paper, I just wanted to share, super excited about Nick joining. I think 2026 is going to be a big year for Bitcoin, Early Riders, or portfolio companies, and part of that is leveling up across experience and expertise. I think that part of the themes we'll be talking about with the white paper and in general is there really needs to be the building of the bridge between TradFi and digital assets. And a lot of that comes down to the commercial relevance and viability. And what that means is there's a lot of companies building great things in Bitcoin, whether it's slightly tweaking the product for the taste of mass market consumer demand or helping those companies. I think that's where we'll focus, and Nick as well, because Nick's worked on very large M&A. He's worked on very large deals. And that's something that's just traditionally missing in a space. Like we know as people that have been listening to this podcast and following the Bitcoin space is that there's certain prudent, pragmatic ways that makes sense to build products long term. The reality is TradFi doesn't appreciate them yet, and it's our job to get that there so it gets the right products with the right firms that are going to stand for a long time. But it's not enough just to say it's the best product. You got to really be able to articulate it and then show that it benefits their end side. And so excited there. Nick will be in Dallas. It's not fully announced. If you're listening to this, you'll get a head start. We will have a Dallas satellite office for early riders and Onramp. You'll be able to meet us and the team because Dallas is going to be a very key and pivotal market given the current macro and U.S. setup and what's happening in Texas. So super excited for Nick. And then we can kind of maybe go to Liam and maybe Liam, when you share about the white paper, if you want to just give any highlights on what the purpose of the new white paper was before going into any of the particular themes.
Yeah, for sure. Well, first of all, super excited to have you on the team here, Nick. And yeah, I think the white paper is a really pivotal moment because it's to a lot of Michael's point too. There's so many principles that Bitcoin has right and that so many folks really have identified with and have benefited significantly by adopting them themselves. Anything from, why understanding that Bitcoin is, more of a signal than all the other digital asset tokens out there, and why there is a need for, cold storage Bitcoin segregated from the internet that is not, rehypothecated. All the principles are exactly right and something that should be applied more broadly to the world. But also the fact that many of the folks out there, especially those who are listening, probably have a significant portion of their net worth in Bitcoin, and significant is relative to whatever they've really identified with in the past. And then once the natural progression of that is once you have a significant portion of your assets in Bitcoin, you really start to understand, well, I at some point allocated to this, or I made this personal expense over here and realized, oh, well, especially earlier on, like maybe I would have been better off just buying Bitcoin itself. And that's kind of how we came to this whole conclusion of early riders in general, was both personally using Bitcoin as our way to denominate our expenses and return on, and just ability to run circles around our peers who still were not living in that mindset, and as well as just the insight of working at the Brown Brother Harrimans and Point 72s of the world to be able to come and bridge the principles of the traditional financial world and what really has gotten right there, and then on the other side, applying the principles of everything that we've done on the Bitcoin side of utilizing the right unit of account, doing more with less, and building the bridge in order to create the right products and services for the market. So I'll take a pause there, but it's almost like a manifesto of how all capital formation will come out in the future, really rooted in practice of being around this industry for a while and understanding what has been going right and then what potentially needs to be improved upon in order to kind of cross the chasm from being an industry just for hobbyists to essentially creating the best-in-class products and services for folks like at the Morgan Stanleys and the highest degrees of finance.
Yeah, maybe Brian, if you go to the top on some of the outline, I would encourage anybody listening, check out this new white paper. I think the core idea is, as Liam said, that this serves as a manifesto for how capital formation will happen in the future. And it really was rooted in two aspects. One is building with a Bitcoin standard, whether it's a personal balance sheet or business balance sheet, you end up coming out to the most efficient outcomes, because once you have the best form of money, you start to root everything into that, which is very valuable to know that money doesn't grow on trees in your decision making. And then on the other side of that, once individuals, if we believe that the majority, if not all individuals, will have to come to that conclusion, well, then the logical progression is they have to credibly understand how they will get more Bitcoin if they're going to participate in an economic endeavor. And so this white paper we initially put out in 23 And we decided to add to it this new white paper because it really exemplified there was a lot of things that we understood early that are starting to play out, whether it's the notion, the biggest one I would say, and then I'd love to hear Brian's thoughts, is the debasement trade, right? We're still early in this theme, but the notion that the denominator is broken. Being early, people hear it, they hear gold, they understand it, but still TradFi at the very margins may start to think about how do they underwrite their return profile in some other unit, whether it's the S&P 500, gold, Bitcoin, but it's still very small. But the logical progression is once people start to question that, then they start to still start the journey on like, well, what are the other denominators that I should be looking at? And then as they go through like what makes a good form of money, what's the best investment, profile when it comes to all the aspects of Bitcoin, you end up in this logical conclusion, whether it's gold or Bitcoin, you want a sound money to benchmark any returns against because everything else is effectively a derivative of that. And then that's really where this white paper goes deeper into like, why would you raise, deploy, and return in there? What is Bitcoin as a hurdle rate? How does it change capital stacks when you think about a company that uses sound money as its denominator? And it goes into like the next steps in that, because once you get that you have a better form of money on your balance sheet, well, that form of money is working in your favor. So you don't spend in the same way as value that's depreciating. So you start to do more with less. So we're really excited about this. We really encourage everyone to take a look at it because it really gives the clarity of thought that comes into how this firm came about. And it's really helped us get a lot on both the investor side, because this is what they've been looking for, but then also on the builder side, because builders out there deeply understand these concepts, but they haven't had them articulated. And once they do, they find kind of like that group, that team, that version that they want to work and build with. And we've really attracted some of Cornerstone portfolios based on this white paper that's come out.
Yeah. Oh, that's very well said. I would say, this notion of the denominator being broken is core to everything we do, core to the thesis. And to your point, a version of that story really entered the zeitgeist this year with gold running, with silver running, really all precious metals, commodities. People are waking up to the realities of inevitable fiat debasement. And while in sort of mainstream circles, it's still viewed as, quote unquote, the debasement trade. I would say we view it slightly differently in that this is a structural long-term shift. This isn't just something that you trade in and out of, because these trends, the debasement realities, happen slowly over time, but they're not. There's no really going back from it, right? Like as Lynn Alden says, there's nothing stopping this train. There's nothing stopping the inevitable fiat debasement, and so you need to be positioned in a way where you can capture or really preserve value into the future in this world where AI is making everything abundant. You need a sound asset to absorb a lot of that. And the other thing I would say is that as we've looked at one of the themes in here that we talk about is doing more with less. And the way I would posit that theme or that part of the thesis is goes back to a quote from Michael Dell that he had a few years ago around constraints breeding creativity. And that's really the essence of what we mean when we say Bitcoin's the hurdle rate. It's the opportunity cost. It by using a sound unit as your denominator, as your benchmark, you're naturally going to be more disciplined, more prudent in your decision making because you're assessing everything against a benchmark, a form of money that's actually going to appreciate in value, as opposed to the opposite, which most of traditional VC has been sort of stuck in this loop for decades of raising as much money as possible, deploying as much, spending as much as you can, trying to show top line growth, revenue numbers via that spending, and ultimately it comes back to chasing the wrong unit and then distorting how capital is deployed, distorting proper price signals in the market. Because again, the unit itself that is being chased typically is not sound. And so you're constantly on the hamster wheel of trying to show growth, redeploy capital, raise at a higher valuation, et cetera. Whereas if you were just more disciplined and held a better form of money, you wouldn't have to worry about that sort of vicious cycle or that loop of deployment, re-raising, getting a higher valuation, et cetera. So it really cuts across various themes in this white paper. So implore everyone to read through this. And like we said, we're releasing a sort of refreshed version of this. But any other thoughts on this, guys?
Yeah, maybe it's a good transition, and then we can go wherever. Is the last link with the AI, because I think AI is a key component of this. AI is acceleration, and what Brian just did is exemplified into the notion of everyone's building these vibe coded apps. There's a theme that's been building for the past couple of years is like there will be the first $1 billion company, but by one individual. And I've always had this vision that that person, it will happen, but it'll be somebody that deeply understands these concepts and ethos. Because ultimately, if you're competing with somebody else that has access to the same tools to vibe code an app, and obviously like there is execution and the entrepreneurial taste for distribution of the market, but let's say those both existed pretty similarly. Well, it all comes down to how are you sweeping your capital into and what are you chasing? Because if you're holding a better form of money, it's appreciating in value. You're going to have a sharper lens in how you build. And so, sorry, it was the last one where why the latest craze of PE and VC rollups won't work.
This video.
Yeah, you don't have to click the video, but just if you pull it up, because it'll show. Well, Liam's or Brian's pulling it up. I thought this was super fascinating because this was a recent podcast that was, I guess it had to do with All In Interview, which was McKinsey and General Catalyst, senior execs, if not the CEO of General Catalyst. But the point being is there's a craze going on right now. It includes these firms, includes like 8VC and others that are doing these roll-ups around, and like, it's like venture kind of migrating because they're realizing that like the venture model won't historically work in this new world. And what they're looking at is like cash flow positive, businesses that are pretty like unsexy, that they can either invest in businesses that will roll them up or funds, and then integrate and infuse like best practices in AI. And at first glance, it sounds great. I expect a lot of capital to flow into these themes. But when you really start to peel back the layers as an entrepreneur, you realize that that is one approach, but it's an approach that won't be the most efficient because you're effectively having to re-architect a foundation that is just fundamentally broken when it comes to the inefficiencies and the people that have been hired and the processes that are part of the totality of the culture, versus if it's just embedded from day one, meaning that you're going to be utilizing these tools. Your team is going to be utilizing the tools from a mindset and also from a productivity perspective. And I think that's really embodies like we are focused on Bitcoin returns doesn't mean we only focus on Bitcoin infrastructure, because there is a much more value that's been delivered to the world that has a lot of fat and inefficiencies. But once you have somebody that understands these concepts and themes and wants to effectively infuse them into building net new companies that compete with the incumbents that are historically fat, mired with inflation, mired with turnover, bad unit economics, this is how we'll rebuild the world to be more efficient and net new value to be delivered. And so I just thought this was interesting because I was always like fascinated by this concept and I thought it would go somewhere, and I still think it will, but it will be like a migration point, not the end state, to basically net new companies building what this will be the category winners. And that's super exciting for what we're working on and who we're looking for to get involved with what we build.
Yeah, that's a great point. And as soon as I heard about Bitcoin denominated firm while I was still at my old private equity shop, it initially clicked like, oh, we're cooked. If this has any credible way to actually outperform or even denominate returns in Bitcoin, it's just so much superior to the existing status quo that over time, all capital allocation will need to come this way. It's just like how over time better money will drive out bad money, and it definitely takes time. And there's the entrenched bureaucracies and status quo that will limit adoption, especially by the established funds who probably know that this is how they should be operating, but can't because it admits that how they were previously doing business is generally not the right way. But on the other side of things too, I think it's important to call out that some folks just literally have no they're like, well, all these concepts are 100% right and I agree with, but there's just no way to outperform Bitcoin. And that's just essentially saying that the world will look exactly as it does in the future, which I generally don't agree with. I think that it will change significantly. And, every day we're seeing like more and better opportunities come through the door in terms of just the acceleration of kind of human progress and technology. And so I would say it's never been a more exciting time in both venture and to be thinking about capital allocation this way.
Yeah, just to maybe put a loop around this discussion, this tweet caught my eye over the weekend from Akash Gupta. He started a company called Product Growth, but what he's saying here is basically the broken traditional VC and founder math. And we've talked about this in the past of like the way traditional VC works is, effectively you assume that 9 out of 10 bets are going to go to zero, and you really need to hit a home run with one or two of those bets. So this says VCs need 3x fund returns to stay in business. $100 million fund needs to return $300 million. If they own 20% of their company at exit, you need to sell for 1.5. So basically saying, there's a misalignment of incentives here between these mega funds and founders effectively, where it says here, the incentive structures are pointed in the opposite direction. VCs optimize for portfolio returns, founders optimize for personal outcomes. These only align at $500 million plus exits. And really the takeaway from this to me was like this misalignment of incentives traces back to, again, chasing the wrong unit. So these dynamics that are being described here are effectively a function of broken money and the broken denominator that we referenced, and the need to basically chase hyper growth outcomes for 10% or less of a fund. And so the way that you combat this is you use a better form of money, and you don't have to effectively be on that hamster wheel of trying to achieve these outsized exits and just assuming that the rest of your portfolio goes to zero. Like that is not a prudent or efficient way of doing things. And so I think people are starting to wake up to a lot of these sort of misalignments. They're still missing the broader solution of tying it back to the money being broken. But I thought this was interesting in sort of the context of this discussion that most people are still missing this, but they are at least somewhat waking up to the misaligned incentives that are sort of pervasive throughout the traditional VC space. What do you guys think on this?
Yeah, I mean, it's a great call out. I mean, what we're talking about here reminds me very similar of sometimes we talk past each other when it comes to Bitcoin and where it sits in a portfolio, because for vast majority of people that are interested in Bitcoin, they don't necessarily underwrite it based on like where gold sat for hundreds, if not thousands of years, and specifically around capital formation. So it doesn't end up as an end state. It ends up as like a sleeve in a portfolio. And it's very similar here when you talk about like VC math and the insanity of the VC industry that's grown over the past 50 years. To really understand how it's a Frankenstein aberration, whatever you want to call it, construct, you really have to go back to how venture started, the purpose of it, and then the reality of whether it's institutional family offices, put in any bucket, have to go further and further out on the risk curve to hit their return profile and benchmark. And then ultimately looking at these like outliers that have provided air cover for everyone to raise a fund, because the vast majority of funds underperform the S&P. And when you look at quartiles, there's very few venture funds that hit their targets. And so this will only increase because of the amount of monetary units. And it really gives like a negative connotation to like venture in itself, because the notion of capitalizing somebody to return more capital is pretty straightforward. It's existed for forever, since money's existed. It's the notion that you need to go for home runs, that 9 out of 10 bets fail. These are all concepts of a fiat system, and that they can exist because you can do the mental model of, in a Bitcoin world, well, what sane person would give up their capital to know that 90% of it is going to be evaporated? And like, what sane person would get out of bed if they knew that a 90% chance they would fail? It doesn't make any sense. But we fund these concepts when they're theoretical, and that we can go for the home runs because the money's broken. So yeah, this I hadn't fully looked at this, but this is kind of a common thread, and really the understanding that if you're going to build a better firm, and that lasts into the future, into perpetuity, ideally, it's that you have to start with the right foundation and then bet that the rest of the market is going to naturally come this way. Because that's one of the most exciting things from an institutional perspective, is when people start to just wake up and realize, well, why am I doing any of this? Why don't I just hold this money that has a venture-like return, but has the safety of bonds? And then that's the first step. And that's what Onramp and other portfolio companies solve for. But then over time, as you get there, as the price appreciates and the return profile starts to diminish, and also as you start to think about diversification, specifically from an institutional or even individual that wants to invest their Bitcoin, well, their natural progression is, well, are you going to give me more Bitcoin than I gave you? Which is a very rational thing to say and do.
100%. Yeah, that's a piece that most of the sort of traditional market is still missing. It's like, why would I want to receive more dollars 10 years from now? You have no anchor to know what those dollars are going to be worth 10 years from now. And so it's completely irrational to lock up capital for that amount of time with the hope of, outperforming the S&P effectively in dollar terms, nominal terms.
So Brian was referencing, we're coming up on an hour, but one thing we did want to call out was the launch. This will be released on Tuesday. Today's Monday. Onramp for everyone. We're really excited about this on the Onramp side because ultimately one of the concepts we just talked about around understanding Bitcoin as your unit of account and savings vehicle is that still far reaching for a vast majority of individuals, because ultimately they don't know how to credibly custody it, which impedes the ability to really get material exposure. And so we've been called, at Onramp, the Rolls Royce of custody. We work with institutions, endowments, pubcos, but a lot of individuals don't feel that they can work with us, whether it's because of our marketing needs to improve or the cost structure. So Onramp for everyone includes an IRA account, individual self-onboarding. We still do white glove onboarding, but then really a flat fee structure, which has been asked for by a lot of individuals. One thing that we're going to do to upgrade, this year is final settlement, doing more kind of just engagement with the audience. One thing is if you sign up, if you want to check out Onramp, you can actually get 50% off your first month using FS. So if you go through, get set up, you'll get 50% out. If you've been meaning to try Onramp and you felt whether all those things that we talked about, you needed an IRA account to be included, the fee structure, or you just didn't know if we worked with you as an individual. So we're super pumped to have that out. Brian, do you have any thoughts on Onramp for everyone?
Oh yeah. This is going to be a big deal for us heading into this new year. I think historically there's been a perception that Onramp only works with super high net worth folks or institutional allocators. And while we do service those cohorts as well, we wanted to reemphasize the individual, because frankly, that makes up the core of our existing client base today is individuals, many of whom who have been holding Bitcoin for a long time, predominantly in some form of self-custody. And they realize that at a certain point, when that portion of your net worth becomes so material that the burden of self-custody and whether it's the physical or digital attack risks, or even just thinking about long-term planning like inheritance and estate planning, you don't have to be on an island effectively. You can use Onramp and also be confident and know that you're not ceding unilateral control to any one particular custodian, which has been basically the pitfall, and why a lot of folks have been in self-custody for years is because they know it's not prudent to just keep coins on an exchange and an omnibus pool where you don't actually have clear visibility or transparency into your Bitcoin. So the way Onramp works is you have a segregated multi-sig vault where three institutions are coordinating on your behalf. You're sort of quarterbacking the quorum. And it's really a fantastic solution for individuals of all kind, whether you're new to the space and don't want to have to go down the path of learning self-custody, or you've been in for a while and you recognize the value prop of what we've built and how it can be accretive to your existing setup. None of this is meant to fully replace self-custody. We believe in self-custody and think it's critically important really to the network. The ability to hold your own keys is massively important. But we think MIC and what Onramp provides can be an accretive element of someone's setup. And just being able to know that a certain amount of your Bitcoin wealth is going to be passed on to your spouse or your kids, for example, with a proper inheritance plan, with legal titling. You can set up all of that stuff easily in app. So this is a big deal for us. But anything else on that, Mike?
No, I think we covered it. Super excited. As mentioned, you can use FS if you want to get 50% off your first month to try it out. And then, like we talked about, we're just going to be doing a lot more with the audience as it relates to special incentives, swag. You'll be able to meet us in market. And then, yeah, I don't know if I want to leave it to Nick and Liam to leave. The one thing I'll share with the audience is we're constantly looking to improve the segments and what we're looking at. We've had no shortage of real high quality inbound from company building. So it would encourage anybody that's thinking about opportunities. We'd love to chat with them. And then also just in the YouTube comments, if you have any other thoughts around segments, opportunities, things we should be focusing on, we're always looking for feedback. So please, it's always nice to hear from the audience. But Nick and Liam, anything before we wrap?
No, I'd just say, yeah, please check out the white paper if you haven't seen it yet. It's really phenomenal work. And would also please reach out and give us comments on the white paper too, in addition to just the segments in general. But then, yeah, lastly, we're going to be trying to do a lot more with, building the bridge across not just, Bitcoin and TradFi on the early rider side, but yeah, with all the portfolio companies too, like Onramp for everybody, kind of bridging all the principles of self-custody, such as proof of reserves built in, no single point of failure, and the experience that everybody is used to at traditional financial UX at banks and fintechs. So yeah, excited for a great 2026, and can't wait to get after it. Nick, anything else?
Yeah, no, I think you hit the nail on the head. I think all I would say is obviously super excited to be a part of the team. I think 2026 is going to be a big year. And I think we're pretty well positioned to take advantage of that. So I think I would leave you with that.
Awesome. Thanks, guys.
Thank y'all.
Thanks for listening to this week's episode of the show. If you found the information valuable, please share the episode with a friend or leave a rating on your favorite podcast app. All the links we discussed in today's show will be in the show notes inside your podcast app. Before we finish, a quick reminder that Onramp Media is for informational and entertainment purposes only, and nothing should be construed as investment or legal advice. Regardless of where you are on your Bitcoin journey, we'd love to hear from you. Visit onrampbitcoin.com/contact to schedule a consultation with one of our private client advisors.